Hi there, welcome to another live webinar with us from Good Futures. This is your facilitator of the day. My name is Sri, and thanks for joining us for another session. What are we talking about today? Today, we're going to be discussing trading opportunities with crude palm oil futures. Well, if you've been trading futures for a while, the CPO contract from Bursa Malaysia should be something very familiar to you. What's new with the palm oil scene is Bursa Malaysia has launched a new futures contract, the East Malaysian Crude Palm Oil. They launched it on 4th October as an avenue for price discovery and also to complement its product offerings. Join us in this session to learn the new exciting developments in CPO and how investors can participate in price discovery and identify trading opportunities. And who do we have in the studio? Well, first up, we have Ryan Long. Ryan is none other than the head of commodity derivatives in Bursa Malaysia. He's responsible for improving and expanding the commodity product offerings in the exchange. Ryan has more than 20 years of experience in the palm oil market. And if you have any pressing questions for palm oil, this is your best chance to direct questions to Ryan. And with Ryan, we have two other presenters. First, we have Michael Sim. Michael Sim is a professional trader. He has more than 20 years of experience in the industry from his years of knowledge of the buy and sell side of the business with Merrill Lynch, and he has extensive knowledge of market microstructure across a broad spectrum of products with a specific focus on index valuation. Along with Michael, we have Ken Orr. Ken is a senior trader of Inspirante Trading Solutions. He joined Synergy Link Capital, a proprietary trading group, in 2018. He specializes in short to mid-term spread trading, spanning across the equity index and, of course, the commodity space as well. Ken, if you have attended AFECT events previously, he was executive committee member for education and also currently still facilitates FCTC, the Financial and Commodities Traders Club in Singapore. All right, so without further ado, let me hand the reins over to Ryan. Let me give you sharing access, Ryan, and on your screen, you just saw Michael Sim appear. All right, Ryan, let me just give you sharing rights. You should see a pop-up on your screen right now.
All right.
All right, go ahead, Ryan. The floor is yours. Members of the audience, if you can hear us loud and clear, please type a resounding yes into the question box. The question box is somewhere at the bottom of your control panel. Just hit down there and type yes if you can hear us.
All good.
All right, thank you, Julie. Thanks for confirming. And Albert, yes, we've just started the screen share, as you can see. Ryan, without further ado, over to you.
Right. Thanks, Sri. First of all, a very good evening to all of you. And I would like to thank Philip Futures for having me. As introduced by Sri earlier, my name is Ryan Long. I'm the head of commodity products at Bursa Malaysia Derivatives. So I shall start with a quick background of Bursa Malaysia Derivatives, also known as BMD. BMD is a subsidiary of Bursa Malaysia Berhad. It was established in the year of 1993. BMD offers both commodity as well as financial derivative products. I will show an overview of all the product offerings in the next slide. So all BMD trades are actually matched on Chicago Mercantile Exchange Globex, right? CME's Globex. It is a global electronic trading platform providing connectivity to players all around the world. So as many of you may be aware of, BMD Crude Palm Oil Futures Contract, short name FCPO, is a global benchmark for crude palm oil pricing. It is the most actively traded flagship contract of BMD. The other actively traded contract is FKLI, the KL Stock Index Futures Contract. So in a nutshell, BMD offers agricultural futures and options contracts, metals futures contracts, financial equity futures and options, interest rate futures, and also bond futures contracts. In fact, we have suspended a few contracts shown on the screen here for product revamp exercise. So BMD launched the new East Malaysia Crude Palm Oil Futures contract last month. We had a virtual launch ceremony on the 4th of October. So the exchange is always looking at options to increase our palm complex offerings to strengthen our proposition as a global benchmark for palm oil pricing. So the contract spec of this newly launched contract is actually identical to FCPO, the Peninsular Malaysia contract, or you can call it the West Malaysia contract, with only 3 key differences. We will go into that a bit later. Right. So the reason and basis behind the launch of this new contract is the growing prominence of East Malaysia palm oil sector. Right, East Malaysia, Sabah and Sarawak combined is currently producing about 45% of the country's total CPO production. And as you can see, since 2013, the export of palm products by East Malaysia has actually surpassed that of Peninsular Malaysia. And historically, if you are looking at the line chart below on your left, East Malaysia CPO has been trading at a discount to West Malaysia CPO. So generally speaking, the discount is about 40 ringgit per metric ton. Right, let's dive into the 3 key differences of the 2 CPO contracts. So first, we have the trading hours. As you can see, East Malaysia CPO contract starts at 9 a.m., whereas the FCPO contract, right, the Peninsular Malaysia contract starts at 10:30. So the East Malaysia contract starts 1.5 hour earlier. This is to actually coincide and we try to align the opening hours to be the same as a Dalian Olin futures contract, right? So that people who want to trade between the 2 exchanges or maybe to arbitrage, they can do so. So the second key difference is the port of delivery, right? So the FCPO contract, the delivery locations are Port Klang, Pasir Gudang, and Butterworth. The new East Malaysia contract, we have Lahadatu, Sandakan, and Bintulu as the approved delivery location. The third difference is the position limit. As you can see, the new contract position limit is about half of the FCPO futures contract. So here are some trade statistics of the new FIFO contract since the launch on 4th of October. The highest daily trade volume was 110 lots. Open interest actually built up to 88 lots at one point. open interest is now at 47 lots as per yesterday's close, with 90 lots traded on the same day. 580 lots were traded during the very first month of the product launch. This month to date, we are seeing 1,016 lots traded so far. And of course, this is not a number to brag about, right? If you want to compare this number with the FCPO contract, which is trading about 65,000 lots in a day, we still have a lot of catch up to do, but we are certainly seeing a growth and progress. Right. So the exchange offer incentives for traders and investors to trade this new contract. Right. There's this ongoing 3-for-1 fee waiver program. That means for every 3 lots of FIFO you trade, you get 1 lot fee waiver for FCPO. Right. So there's also this FCPO and FEPO inter-contract, or you can call it inter-commodity spread credit of 70% in place. That means if you only pay 30% of the margin for both FCPO and the FIFO leg, if you have a short-long spread position. Right. So currently the margin for FCPO is about 7,000, and the margin for FIFO is 5,000. So combined, it is actually 12,000. But you only pay 3,600 per FCPO and FEPO spread pair, right? So many professional traders are, or even well-educated retail investors are already trading FCPO calendar spread, right? Going forward, we actually foresee more participation in FIFO and FCPO spread trading. It is actually another good proposition for palm oil commercials as well as retail traders. Next, BMD provides learning resources to people who are interested in familiarizing themselves with derivative trading. We have a derivative trading simulator. We call it DTS. You can find real-time prices, real-time codes, charting tools. You can have order placing and position management monitor. It is actually built on top of QST platform. So QST is actually the foundation of this simulator. Right. Okay. You can actually go to Bursa Marketplace to sign up for or to subscribe for a free 30-day trial. Right. It actually comes with 100,000 ringgit virtual money for you to begin your learning journey with. So it is actually very realistic. You actually get a daily statement sent to your email after you have done trades using that platform. Right. This is how DTS screen looks like. Yeah. So it's exactly the same as the USD platform. Right. So we have many learning resources available on Bursa Academy website. So this is how the main page looks like. You can also find resources on equity trading here. So you just need to select the relevant tab, right? You want equity or you want derivatives. And so as you can see, many various types of topics on derivative trading are covered, right? Including option trading strategy, physical delivery process for FCPO, or even how to automate FKLI trading using AI, right? And many more. So do check it out. Right. So that's all I have to share for today. Thanks for your time.
All right, thank you so much, Ryan. First up, we're going to have our senior trader from ITS, Mr. Ken. You'll be going up next. Let me give you showing rights. All right, you should see a prominent screen right now.
Yep. Okay, are you guys seeing my screen now?
Yes, yes, I see.
Just give me a moment, yeah. Okay.
Well, while Ken is
Okay.
setting up his view for the presentation, members of the audience, if you have questions for our traders as well as our BMD rep, Mr. Ryan Long, you can go to the question box which you have on the control panel. It's somewhere at the bottom, and type the questions in there. We'll be picking them up at the during the Q&A session at the end of the webinar, and we will be getting the answers to the questions that you have. All right?
Okay, I'm ready to go.
All right, go for it, Ken.
Okay, thank you, Sri, for the intro earlier, and good evening, everyone. I'm Ken. Thanks for taking your time to join us tonight. Also, thanks Philip Futures and BMD for organizing this session. Okay, as always, let's start with the disclaimer. Do note that all the materials and information presented tonight are just for general education only. You should always do your own due diligence and seek advice from a financial trader, or excuse me, a financial advisor. The views shared tonight are solely in our own personal capacity based on what we do and how we do. Okay. The slide is okay. All right. Further to an introduction from Sri at the beginning, allow me to bring your attention to Financial and Commodity Traders Club. This is a trading community set up by ex-IMEX floor traders for the traders. So do come and join the community through our Facebook page via the URL link that is indicated below. Okay, and here's the agenda for this evening. Are you all seeing it? Okay, because I have some lag. Okay. I will do a brief introduction of our company, Inspirante Trading Solutions, in short ITS, and also what we do, followed by welcome to our trading room, where I will share our goals and principle in this business. Next, I will give you an overview of the newly launched East Malaysia Palm Oil Futures, which Ryan has already touched on quite a fair bit of it. That helps me to cut short my time. Thanks for Ryan. And thereafter, Michael will present our palm oil spread trading strategies. And lastly, Q&A to wrap up our session. Okay. All right, ITS. It was founded by the partners of Synergy Link Capital. It was set up in 2020. The purpose is to consolidate our initiative in fintech solution and research. We have a team of active traders with different backgrounds and experience trading exchange-listed derivative product in all asset classes. We work with various exchanges by conducting webinars for their respective derivative contract. Okay. We also conduct professional trading workshop and mentoring programs. We will design our syllabus as best as we can to conform with the prevailing market condition. And this is because as market evolve and change, any winning strategy that once worked can very easily and quickly be rendered irrelevant and outdated. Over the years, we have witnessed, unfortunately, many traders falling off the cliff when the market dynamics change, and they are unable to adapt to the new norm. Hence, in ITS, we strive to nurture students and equip them with an ability to adapt, evolve, and stay relevant under different market conditions. We have actually conducted a couple of classes in Malaysia and Singapore prior to this COVID lockdown. And we are proud to say is that some of our students have seen substantial improvement in their trading. Okay, for your info, we have a second class for Singapore this coming December 18 and 19. Hand-holding session will be held on the 3rd and 4th Jan. In fact, you should come meet and chat with two of our trainers this Thursday, 2nd December, 7 to 8 p.m. to find out more about the masterclass and have your query addressed. Use the URL link provided below to register your attendance. And also, you might want to visit our this preview that we have done earlier, and the FAQ as well, recorded on YouTube prior to this Thursday session. Okay, last but not least, we also contribute bi-weekly excuse me, market commentary to CME. The newsletter is titled Fresh from the Trading Room. We touch on key economic events across global markets and major asset classes. There are also some case studies for your reference. You can subscribe to it on CME Group website. The URL is also listed below. Okay, next, welcome to our trading room. Well, a typical day for us starts at 7:30 a.m. and ends at 6 p.m. for the tea session. We trade Asian indices and commodities. Now let me share with you our goals and principles in this business that has kept us alive basically all these years. Now, for the goals wise, for most traders, it is to make money, okay? But in the context of professional trading, our goals is not only to make money, but also to build wealth while ensuring the long-term viability. In essence, we approach trading as if we are running a business, and therefore our consideration for potential risks will always supersede the potential profit. And here are the three principles that have guided and kept us alive trading professionally. Number one, preservation of capital. This is necessary in order to keep in this business for as long as possible. That means to avoid taking unnecessary risks such as overtrading. There is a saying, the market is always there. Live to fight another day. Number two, consistent profitability. To achieve this, you need a simple trade plan that is replicable while taking care of the downside. The approach you take will determine the outcome. For us at SLC, it also means doing a lot of research, back and forward testing, and refining strategies. And number three, pursuit of superior returns. This will get easier after you put in place the first two principles. One way is to let your winners ride with trailing stops to enhance your return. Never let your winners turn into losers. Okay, now let's take a look at the fundamental drivers of CPO prices. As you know, commodity prices are mainly determined by the forces of supply and demand in the market. Supply in terms of production and inventory, while demand is derived from export figures. The two laws interact to determine the actual market price and volume of goods on the market. Generally, as price increase, people are willing to supply more. At some point in time and beyond a certain price increase, demand will fall. And that's when customers will begin to look for alternative, if there is one. In the case of edible oil, palm oil is a substitute for the premium soft oil such as soybean, sunflower, and rapeseed oil. Similarly, for the non-edible oil industry, palm oil is an alternative for biodiesel production in the global market. So when we are trading CPO, we need to look at the grain and crude oil market sentiment because they have a close relation. Not forgetting factors such as currency movement, geopolitical situation, economic growth, and of course, Mother Nature. Okay, this is something which Ryan has touched on. Okay, the three key differences, which you have heard of that. So now for the trading hours, and because EPO starts 1.5 hours earlier, which is in line with the Dalian Palm Oil opening, this actually in turns offer more trading hours between inter-exchange. Okay. And for the port of delivery, now that EPO is delivered in their respective regional ports, this should actually reduce the price differential between EPO and CPO in due course. And since both are identical product, then there should be some arbitraging opportunity as well. Okay, as a newly launched contract, then BMD has halved the position limits. As you know, position limits is actually there to prevent any entity or individual from exerting undue control in the market during this infancy stage. So I'm sure as the market, the contract matured, then the limits will be adjusted accordingly. Okay, this is what Ryan has covered as well. Quickly, you can see the stats between both of them. 1995, Sabah and Sarawak only contributed 22% of the total CPO production. By last year, it was 45%. And this is probably expected as since Sabah and Sarawak has a total plantation area of close to 3.06 million hectares, which is more than West Malaysia combined. And then, of course, then since they are producing more, the palm-related products also surpass Peninsular Malaysia, which amounted to about 49 billion ringgits. Okay, let's look into the stats. Okay, looking at year-over-year production figure from 2019 to 2021, CPO production slipped for most part of last year. And this year, we saw 9 straight months of decline from January as compared to 2020. Well, as you know, palm is a labor-intensive industry. The pandemic lockdown resulted in shortage of manpower, which in turn affected harvesting and production. It was only last month that we saw an uptick, which is on par with October last year. However, we are actually going into the monsoon season of the year, which will have an impact on the harvest. Okay, next let's take a look at the demand side. Okay, export hasn't been that rosy either. I mean, there were only 2 months of slightly higher export volume in March and April this year, but the momentum didn't follow through. This could be due to higher taxations and levy as the palm prices rise. And the ongoing pandemic compounded the problem in terms of logistic bottleneck. There is also an increasing structural influence from the green movement, which is focusing on sustainability issue, evidently in Europe. Okay. As with other commodity products, CPO price will fluctuate depending on the level of global stockpile. Okay, the above stat from MPOB shows that the monthly closing stock level has been registering a year-over-year decline since September 2019, with the exception of August and October this year. I mean, this could actually explain why those of you who are trading palm now, the price has already rallied way above $5,000. Okay, as mentioned earlier, we are currently into the low season, which this may stretch into February next year. Okay. Right. This table is the heat map of palm month-over-month price movement. As you know, CPO has a seasonal pattern every year, which is low season typically starts from November until February, where production start to decline due to the monsoon season. The harvest and yield are sensitive to these climate factors as the amount of rainfall, or even currently we have this La Nina effect that is going on. And usually when there's not enough rain, you don't get juicy fruits. On the other hand, when there's too much rains, some of those plantations on the low-lying area get flooded, and this definitely disrupt harvesting. And moderate seasons usually begins from March until August, before the production peaks in September and October. As you can see from the data compiled in the last decade, bullish months are May, August, October, and December, while bearish months are Jan, March, April, June, and September. We can use this data from this heat map to better position for those higher probability trades. Okay, this chart pretty much sum it all up. With price reflective of the current fundamental situation. This was updated as of last weekend. This COVID crisis has triggered a big rally in almost all commodities amid this lockdown, supply fears, labor shortage, and unusually high demand. And also the panic buying driven by fear, led to depleted store shelf and stockpiling goods at home. To make matter worse, there is also a supply chain bottleneck, as I mentioned earlier, which caused record shortage of everyday product, from household goods to electronics to cars to food and raw materials. From late last year, edible oil saw this big rally. Both soybean oil and palm oil rallied to a high of 1,300 USD per ton for soybean and about 1,250 USD per ton for palm. And palm oil has been one of the preferred substitute of this premium soft oil. From the start of this November, palm is trading premium over soy oil. So if soy oil continue to trade at a discount, we may see a demand shifting to soy oil. Before the news release of this new variants, Omicron, last Friday, I mean, this rally has been trading around a higher price band in anticipation that the country lifting lockdown, reopening borders, and all that pent-up demand is going to rally the price further. But however, now with this Omicron, there's spell out all this uncertainty. I mean, the scenario may change and it's now anyone's guess. If this new variant will cause another big wave of infection and force all the borders to shut again, one certainty for sure arising from this uncertainty is that it will create volatility, which is actually good for the market and good for us. Okay, and this pretty sum up my sessions, and I shall now hand you over to Michael, who will share with you our spread trading strategy. Over to you, Michael.
Hey, Mike, I'm going to give you sharing right.
All right, thanks, Suri. Now, hi, good evening, everyone. In the essence of time, I'm going to start talking while I'm sharing my screen here. Thanks to Philip for giving us the opportunity to speak with you guys here tonight. I'm just going to dive right in here. Okay, let me see. Here we go. Can you guys see my screen?
Yeah.
Cool. Let me get the slide starting. All right, spread trading in the East Malaysia Palm Oil is what we are here to talk about tonight. So now, where did we start? Actually, I like to borrow a slide from earlier. This, as you recall, is in Ryan's slide as well. It basically depicts the spot price difference between Peninsular and East Malaysia Palm Oil. Now, if you notice that historically, Peninsular Malaysia Palm Oil holds a premium over the East Malaysia Palm Oil. Now, that's for a reason I'm going to explain in a while. But what I like you to take away from this chart is basically when you look at this chart, now, although it's always at a premium, and the average of the last 10 years or 15 years or so is approximately 46 plus ringgit for the Peninsular Malaysia Palm Oil spot prices over the East Malaysia ones. Now, the thing that I want you to take away with you is if you look at this chart here, the recurring nature of it going up and down whenever we hit one bound or the other depicts a kind of very repeatable, consistent relationship, which is what I'm going to propose my first trading strategy on in a second. All right. Now, as you can see from here, right, the important thing is the stability between this and repeatability, so that we can actually have a trading angle on this particular proposal that I have for you. And just a side note. Now, previously, the CPO was only physically settled in the in Peninsular Malaysia ports. Now, with the new FEPO, we got new additional ports that's located in East Malaysia itself, and we certainly think that this premium will eventually shrink, if not go away altogether. But it'll be interesting to see when the ups start coming in and providing another angle of trading between these two contracts, which is essentially in the same space. All right. So where do we start? Like I said, if we look at both contract, if you look at FCPO, which you're more familiar with, and FEPO, they're essentially the same, other than what Ryan explained earlier, the difference in terms of trading limit, trading hours, and margin and whatnot for now. You can also see the similar demand and supply dynamics applying on the FCPO, which is directly applicable to FEPO. I mean, they're in the same locality, in the same tropical belt as well. So the weather patterns also in a way, it's applicable to both in the same manner. Okay, and then next, we obviously with this, we could actually reasonably expect them to have similar trading profile in the sense that they would behave pretty similar in a trading perspective. Okay, and it is from here that we infer what we already know well, the FCPO, and we can try to extrapolate what we know from there and how we've been trading from there into FCPO. I think that would be very applicable in a sense. All right. Okay, now just before I move on to the trading problem, I'd like you to look at this term structure of CPO. Now, it basically is a chart plotted of the individual expiration month all the way out from the first to the number 24, which is 36 months out. Two things you can take away from here. First of all, obviously, most of the actions are focused in the first 12 months of the listed contracts. That's one. And the move between the various timeline curve basically are non-linear, meaning they don't move in a straight line, neither do they move in equal magnitude, but they do move together in a sense, all right? So the slope itself basically reflects what we call a carry relationship between the different expiration. And one of the ways to actually trade this particular relationship is by a spread setup. Now, a spread is where a trader go long or short actually go both long and short a contract simultaneously. Now, for the purpose of today, I'm not going to elaborate on the others. We're going to talk about FCPO and FEPO spreads, both in calendar and inter-exchange. Further, I will talk about Thailand palm oil, but we will save it for later. Now, the groundings of any pair trading is founded on this step measures of correlation and co-integration. There are a lot of information of all this on the website that you can actually easily find out. So I'm not going to elaborate on these two things, but just understand it basically depicts the kind of relationship between the two products that we consider in pairing out into a spread and the strength of the kind of relationship. Now, obviously, when we are trading a spread like what I show you in the chart of the CPO spot price differences. Now, if we can find a repeatable pattern, a kind of consistency, a kind of predictability, that it's obviously something that we can trade, but we must first prove that that relationship exists. And these are two measures, statistical measure that we use to determine that. Okay, now, why do I start with spread trading? Now, it's one of the things that we are very familiar with, and also because it offers a lot of advantages that you do not have in a normal outright trading. Now, first of all, it lowers the risk profile considerably. When you do a spread trading, you're essentially long one and short. Now, suppose if you're long CPO February and you short CPO Marches, you are essentially net neutral in terms of CPO. Okay, it's just that your exposure is in different expiration of the curve. All right. So if something was to affect CPO overnight, let's say for example, some like new policy or some whatever news that might actually impact the demand or supply side, it will move both months more or less, not more or less in the same direction, more or less in the same amount as well. So in that sense, you actually have a way lower systemic risk when you set up a calendar spread in this manner. Now, obviously, Ryan also explained whether you do a calendar spread or do a FEPO versus SCPO spread, for example, you get margin credit from the exchange, approximately 1/3 of what you would be paying to do an outright. Okay. Spread is also an interesting way to take advantage of relative value diversion, meaning, like I said, if both are in the same complex, they should more or less trade in very similar or very close manner, all right, like a close cousin, for example. And now, for reasons I will explain in a while, flows or otherwise, or on opinion, for example, an expression of opinion, they can sometimes, that relationship can actually sometimes take a temporary tear, and this is where you want to go in and take advantage of this kind of relative value diversion, is what I mean. All right. It is also an excellent way to trade seasonal trends. Seasonal trend being what Ken was mentioning earlier, the high and low seasons of production, demand, export, and stuff. So you can actually use a spread to position yourself for that kind of trades. Okay. Now, spread in and of itself, although it's made out of two legs or more, you can also look at it as though it behaves like a outright trade, meaning if you take a direction on where the spread is going to be, for example, okay, and you do so with a lot less risk, okay. Finally, there are simply more ways that you can actually be profitable coming out of a spread setup. All right, what I mean is, like, for example, if you do an outright trade, let's say if you go long and buy a contract, a CPO contract. Now, the only way you're going to make money out of this is when the CPO moves further up. If it moves down, you'll be losing money otherwise, yeah. Obviously, with all these advantages, it's not that spread trading does not have its downside. Okay. First of all, when you talk about spread, minimally we're talking about 2 legs in, 2 legs out. All right. So the commission is minimally double that of what you see in outright. Obviously, in certain type of spread setup, you will actually involve manually legging. What I mean is you actually have to execute one leg, and then while you get done, and you have to be doing the other leg of the spread. And chances are possible. It's also possible that you actually miss out the offsetting leg of your spread, and that's what we call slippage. Okay. And for certain spread, right, outside of the exchange, for example, let's say we talk about Dalian Palm Oil versus BNB FCPO, for example. You're not going to get margin offset in a sense. So that is also another consideration, because in that sense, you will be doing 2 outrights, or you have been margining on 2 outrights in a sense. So it's as good as the outright trading margin quantum. And finally, before I go on this, understand the correlationship and co-integration is actually part and parcel of your pre-trade performance, evaluation to actually set up the trade. It may actually change over time. It does not remain static. Okay, a lot of times this thing can change. It just doesn't change from day to day. All right, so there's one other thing you need to pay attention to. Okay, earlier I mentioned there are a lot more ways for you to profit in a spread type setup. I'm going to quickly just go through it now. We're going to start with a buy spread position. Now, for commodity in CPO, for example, when you buy a spread, you buy a front month versus you sell a back month. Say, for example, you buy February CPO and you sell March CPO. You'll be buying the February-March spread. Okay, so now if we buy a spread like that, how can we be profitable? Now, if scenario 1, if you buy a spread and at this point, for example, and it expanded, you basically are looking for the spread to expand. Now, the front month February goes up and the back month March goes down. What it means is your long leg goes more in the money and your short leg goes more in the money as well. So in that sense, you make money. Now, scenario 2, if your February goes up, well, your Marches also went up. But if the February went up so much more than the Marches had, you're actually seeing an expansion of the spread. In this case, you're profitable as well. All right. And the next one, if you're looking at both months falling, for example, the February down and the Marches went down as well. But suppose if the Marches went down a lot more than the February, and in that sense, the spread will also have expanded, your long position will also be profitable. Now, flip side, if you're looking at the sell position, obviously in this case, let's take the Feb March again, you'll be selling the February and buying the Marches in this case. How would you be profitable? Okay, based on your setup, you'll be short the February and you'll be long the Marches. Now, if the February went down while the Marches went up, essentially the spread is narrowing. You will be profitable in this instance. All right. And the next instance, for example, if both months went down, your short February went down, the Marches where your long also went down. But in this case, the February went down a lot more than the Marches. So essentially not immediately visibly obvious. The spread have narrowed from your entry point to here. So in that sense, you will be profitable as well. And finally, in this scenario, where the near month rises and the far month also rises, but this case where your February rises a lot less than your Marches, which you were long. In this case, the spread also narrows. So your short position would have been profitable. Okay, now having explained that, so we need a trade angle. All right, I'm going to propose a mean reversion type trading because of what I have shown you earlier, the reverting nature of the prices between the Peninsular Malaysia and East Malaysia palm prices. And then I'll show you how we set it up and what are the contract selection given the liquidity considerations. All right. How do we go about doing this? Well, like always, we start with observation and studying the historical price data between the spreads that we intend to set up. First, we establish this relationship. Now, obviously, between East and West Malaysia palm, they are still palm in a sense. They are essentially the same contract, right? In futures terms, obviously, because of locality and the way it's set up is slightly different only in that manner of physical delivery and stuff, right? So basically, once you get that sorted out, you decided to do the pair, then you can observe the historical value and construct the upper and lower bound of that historical price movement. And then you put on a trade when the current spread is nearly approaching the upper bound, or you put out a short trade. If it's going down to the other way, the lower bound of the historical spread range, then you will probably be looking to put on a long position. All right, and you unwind those position as it trades back up to its mean or even further on the opposite side of the historical bounds. Okay, now the first spread I'm going to talk about is what Ryan also mentioned earlier. You get 70% margin credit for this. Remember that? The FEPO versus the FCPO spread. Okay, now this was explained earlier, right? So other than the trading limits, the trading hours, essentially the East and West Malaysia futures are essentially the same. I mean, the port of settlement is slightly different now that East Malaysia has its own, but otherwise it is identical in every other manner. Okay, now if you want to trade this spread, obviously both contracts must be open. Now, though the East Malaysia opens up earlier right now, the Peninsular Malaysia CPO opens up, FCPO opens up at 10:30. This is where you can first start trading this spread, and it trades all the way at 12:30 for the AM close, and then it continues from 14:30 to 1800. Okay, so these are the two periods of spreadable timing that you need to keep watch. Now, for the purpose of illustration, I'll be taking the FEPO price, subtracting the FCPO price from there, and 1 point is always the familiar 1 tick 25 ringgit type. All right, now drawing from raw data, I mean it's very limited since that FEPO just started, but I do what we can based on our observation or data collected. All right, so these are the these Gen and Fed prices between the two contracts. After I subtract one from the other, the top price, the top side of the chart are the individual prices of the contract, and the bottom one is the price depicted in spread. I apologize if it's kind of small, but it basically shows. Later, I'll show you a larger chart on this one. It basically shows a recurring nature in the sense of the spread being always trading within a defined range, which is what we have saw in the spot price difference earlier, right? It has been maintained the relationship for a long time, and there's no reason to expect otherwise right now. So when we actually extrapolate this in the futures, we expect the same kind of relationship to hold, which is the case from what we observed so far. But keyword is, given the limited data, we see what we see right now. So, but as far as we can see, this relationship still holds true. Right, so this is in terms of just spread points. As you can see, there are a few outliners. I'll explain to you what I will do in a while. Okay, but generally speaking, if I were to expand this spread, this chart even further, you will see that there's a lot of up and down, but usually within a confined range, sort of. All right, so this will be more obvious. What I did here was basically I apply a statistical filter, taking out the outliners. The reason is FEPO, because it just started, right? So a lot of times the price data is a bit far off initially. So there are some outliner price which I like to exclude. So I use a 1 standard deviation filter, so to get the smoothness in the price data. Now, after I did that, you could obviously see there is a lot more recurrence in that spread price data now that we can see on this chart here, right? Okay, this is like what I told you earlier. After I put it up here in the bigger picture, you look at these Gen and Fed data here. After I applied the filter, now essentially you see the ups and down kind of thing, but it's usually within a fairly confined range within the day itself. So that actually gives us an angle to trade this in a mean reversion type of setup. All right. So what we mean down here, all right. So if the relationship hold, what you can do is you actually observe how they trade. What are the range on an intraday basis, on the intra-week basis? Okay, what are the high and lows of this particular spread? For example, based on our observation, is somewhere between 25 to just above 40. All right. So if I was trading this, I have started trading this. What we will be doing is essentially what I mentioned earlier. If it hits a lower bound towards, like, to say 30 or just below 30, I'll be looking to long this spread, for example, and I'll be looking to unwind it as it actually goes up to around 30, 35 to nearing 40, for example, and possibly going short, establishing a short position as they approach the high side around 40. Okay, now based on the 3-month data that I have, on the this Gen Fed, the same type of relationship actually host, and I have some limited success because there aren't a lot of trade right now, guys. But the principle of this trade, or the idea of this trade, actually works. You just need to be a little bit patient, and hopefully with more participants and the ups coming in, you'll get a lot more opportunity in this spread. All right. Now this is a definition of the spread relationship, like we talked about earlier. Combining the 3 months, as you can see, there is a big concentration in the middle here, which is the range that we have been seeing, roughly around just under 30 to just above 40. All right, I know it's approximately a 10-point range, but do not underestimate this 10-point range. If it's consistent enough, I will always be looking to buy 30 and sell 40, for example. I'm not saying this is what I will do indefinitely, but for now, at least based on observation, this is what is quite doable. All right. Okay, this is a bigger picture of what we have been talking about earlier, but applying a more objective statistical Bollinger Band here. All right. So for those of you who are familiar with Bollinger Band, basically apply across the curve of this spread. For example, you will be looking for the upside here, the upper band, and the lower band for entry and exit, for example, or entry of a short here, entry of a long here when the price hit, for example, and then you just look to unwind the trade when it goes the other way. All right. So the same for the January and the February trade. All right. All right. I hate to be so brief, but generally I hope you get the idea. It's a spread based on that observation of the consistency between the two locality. We expect the price consistency and relationship to hold true still. It's just a matter of positioning ourselves based on what we observed so far. This is what we've seen, and I encourage you to take a look. Now, obviously, if I was how I am doing this actually is I actually would be quoting the FEPO against the FCPO. The reason I'm doing that right now, relatively speaking, FEPO is still the less liquid contract compared to the FCPO, which is like the a very seasoned cousin here. All right, so obviously I will how I will do this spread is basically I'll place an order in the FEPO, and once it gets hit, I'll be hedging it on the other side FCPO to make it into a spread. All right. So okay, the next spread I'm going to talk about is Dalian, the palm oil futures versus FEPO spread. Now, as you can see, one of the reason, as you can see, one of the difference of the FEPO versus FCPO is this earlier opening, right? And I think part of this was designed to meet the opening of the China market. Now, one of this popular contract that we actually closely related to what we are trading here is the palm oil, all right, which also opened at 9 to 11:30, then closed for lunch from 1:30 to 3 o'clock, and finally the night session from 2100 to 2300. Oh, coincidentally, BNB will be introducing the T+1 trading soon, and that will be good news actually. That would mean that we have less time for ourselves, and we will be doing a lot more of night trading then. Okay. This is a chart depicting the price relationship between the DCE palm oil versus the CPO. As you can see, it's generally very stable. There was a slight tear from early 2020 onwards. That, as we are familiar, is the basically where the COVID start kicking in and stuff start hitting, and we got basically all the bottlenecks and causing the edible oil complex to rally like it had never been before. So there was a slight tear there, but essentially it's still in the same direction in a sense. Okay. Now, palm oil versus CPO spread. The unique thing about palm oil is it does not trade. How should I put it? Okay, the most popular contract or the most liquid contract on DCE palm oil is usually the Jan, the May, and the September. Habitually, it has always been like that. So now, given the difference in preference of contract and therefore liquidity concerns, we need to know where is best to trade May, when is best to trade Jan, and when is best to trade September, when we are matching the expiration between palm oil and CPO, for example. Now, in our experience, usually about 4 to 4.5 months prior to the expiration month, like for example, if I was looking at the Jan contract, Jan palm oil, I'll be looking at the same expiration in CPO as well, obviously. But the Jan palm oil typically get active as the OI takes over, which is approximately 4.5 months before it hits the expiration month. Okay, now the same consideration we can see in the May contract of palm oil and the September contract in palm oil. In summary, basically we'll be looking to trade the Jan expiration. By Jan expiration, I mean we'll be looking to do the Jan palm oil versus the Jan FCPO and May and and so on and so forth. All right, the Jan I will start looking at around mid-July to mid-November, after which the May contract will be taking over because of the switch in open interest, and finally the September I'll be looking to trade it from mid-March to mid-July. All right. Okay. Also, the other thing to note is the trading hours. Obviously, we mentioned earlier. We can basically. My apologies. This is a slightly outdated chart. Now we can trade it from 9, all right, to 11:30 for the first session, and then for the second session we can start at 14:30 to 1500. For this spread. And obviously by the time we have night trading on CPO, we can trade a night session as well. All right, so very quickly, if we were to look at the two sets of prices, the May Sep, the Jan, May and Sep, okay, now the same rough about the same kind of pattern that we saw earlier is presenting itself again. So this is a curve, but it's non-linear. It's more or less reverting along the line. So that kind of relationship that we are looking for. Now, first of all, I've already expressed this all in CNH. We have to compare apples to apples. So I've converted the CPO price to CNH as well. All right. Then I plot this spread price against the movement in MRR spot against CNH. So this is basically what you're looking at right now. There are very few hiccups or dislocation of relationship in the sense. All right, after which I actually did a investigation as to the best parameter to use based on the Bollinger Band width that I'm going to choose, the width, the periodicity of the Bollinger Band consideration, and also the length of trade that I wish to hold. Okay, now in essence, I've narrowed it down to about 3-hour a period Bollinger Band, and I'm looking at the holding period of between a Bollinger Band width of between 80 to 100, actually 100 being the 100 means 100 points on either side of mean, all right, to be giving me the best outcome given the risk consideration. All right, so okay, I know it's kind of small, just bear with me here. Let me get you the numbers. I'll read the numbers to you actually. All right, so now this basically is a summary of a backtest that we run on the trade that we propose here. Okay, basically you trade the palm oil versus the CPO spread matching the expiration and given the time span I'm talking about earlier. So the same mean reversion rule applies. All right, you sell when it hits the historical high and you buy when it hits the historical low, for example, and then you unwind when it hits the other way. Okay, now in essence, when we apply a simple logic over this kind of thing, we actually came back with a very impressive 90+% win rate. That means 90% of the time you are winning. Now, obviously, these are a bit idealistic. We have not taken into consideration slippage, commissions, and the likes of this presenting by itself. Okay, but it is actually very doable. Even if we give discount to that number, it is still far north of 60%. So I say this is a very doable trade in the way. And in our experience, this has been the case. All right. Okay, these are basically what I've shown earlier. Now, if you were to actually use the optimized Bollinger Band that we suggested earlier, the 3-hourly, and using a 80 to 100 points, in this case is a 100 points bandwidth, for example. So you will be entering a short trade whenever it hits the upside of the Bollinger Band and look at unwind when it hits the mean and go short again and go short here, and then you finally unwind here, and eventually when it comes here you'll be looking to go long, or there'll be some point where you'll be going stop as well. All right, but you get the idea, right? Selling when it's high and buying when it's low, and then reverting the other way. Now if we continuously do that, like I said, the win rate shows a very promising 90+%. Okay, now even if after we discount everything that we have said here, but given that the minimum, we use minimum optimization and variable, I say this is actually very, I wouldn't say it's very close, but in my experience, north of 60% is not an issue in this trade. You just need to manage your trade very carefully. Like one of the biggest costs of this trade is actually slippage. DC being a different exchange of BMD, depending on what kind of trading system you use. Obviously, you need to link the trade, right? And you will be linking CPO versus palm oil, because palm oil is the faster moving one in this two. So I would actually be doing that. But let's say if I was doing this spread and I actually bought my CPO, but I failed to sell my palm oil on Dalian, for example, I'll be having to move my price, adjust my price accordingly. That would affect my entry price as well. All right, that's what I meant by slippage. But based on the back test that we did and using the optimization figure that we did just on the statistical parameter, it actually has very good potential in terms of win rate as well as average P&L. All right, this is the same bar chart I was talking about earlier when we show you the FEPO versus the FCPO spread. In essence, this particular spread also actually trades majorly in a very narrow band. Okay, and case imagine if you hit the lower band of this range, this record range, for example, you'll be looking forward to going long, and vice versa. When it goes the other way, you'll be looking to go short. Now, obviously, this relationship can change. The extent of the range can also change, and that is where proper risk management, like Cam mentioned earlier, comes in. All right, so I'm not going to bore you with the details of how you're going to manage your risk, but just know that it's not optional. You need to have a plan. Let's say if you go short here and the market continue to go against you, at which point would you call it quits and just get out of the trade and then leave the trade another day when opportunity presents itself? All right, so in summary, in combination of the 3 months using the optimized number, for example, right, we have approximately a 93% win rate, okay, with an average of 46, almost 47 ticks on this trade, with 103 trades winning against a total number of 111 trades. Now, the trade number here, total number of buy and sell, 43 against 68, is pretty even, meaning you'll be getting a lot in and out, and the trade is oscillating in the manner that we think it is, and is most ideal for mean reversion trading. All right. Okay, with that, I come to the last of my slide. I'm going to pass to Siri for the question and answer session. And just in case you have any question or anything that you wish to clarify beyond what we presented here today, this is my email and Ken's email, and you can drop us a mail if you like to, or you can pass your questions to Siri and they can forward to us. And finally, these slides, I will let Siri expand on that. All right, Siri, over to you, please.
Hi, hi there. Thank you for staying with us all the way to the end. Well, this is the time for you to ask questions for our speaker and representative from the BMD, as well as our professional traders, Ken and Michael. The first question that we have at the moment, I have that on hand. For the rest of you who have questions, please type them into the question box. Make full use of this opportunity to ask the traders questions. All right, first question. Is it possible to create a trading strategy purely on statistics or technical analysis only without fundamental analysis? So just statistics, technical analysis without fundamental analysis.
Okay, can I take that one? Right, guys. Theoretically you can, and we actually do some of our strategy that way also. But I have to say, the keyword being, if you do not have a fundamental understanding of why things happen the way it did. Now, be it whether you do just on a, let's say if you created a system just purely on technical and seasonality, for example, seasonal patterns. If you do not understand the reason for behind the seasonality, when things start to change, when it starts to move out of range, you will not be able to spot it. You will not be able to understand why it is, and you'll be losing money in those instances. And usually when you do not see those coming is where it hurts you the most. So it is possible, but ideally we need a minimum degree of understanding fundamental side of things, like why it happens and how it happens and when it happens. I hope that answers your question.
All right, the next one we have is, all right, so let me give you a scenario. If I have a full-time job right now and I wish to trade part-time, how do I decide on my trade frequency and which time interval should I look at?
Okay, if I can take that one as well. Well, trading is as varied as there are people in the world. I mean, what I meant is like there is no one workable magic formula for everyone. It really depends on how much time you want to devote, how much time you can devote, and what you can do basically. I mean, it's not for everyone. For example, we are a team of approximately 10 traders right now, and each of us, although we're trading similar products, even similar trade ideas, for example, we approach it essentially quite differently actually from individual to individual traders. What I meant is like the entry and exit consideration, duration of trade holding, and the period of our screen time, for example, are different from each traders. Okay, so but then it doesn't mean that just because I'm here sitting here watching it like at 7-Eleven store doesn't mean that I'm going to be profitable all the time. Okay, it doesn't equate like that. You have to work out what work best for you and how much time and effort can you devote into this. But either way, what I'm telling you is that there is no one magic formula for all. So you can work either way. All right, you just have to try to make it work in a way that makes sense for you.
All right, on to question number 3. Thanks, Mike. Can I know what's the period of your DCE FCPO chart? It seems to be a line chart, but is that a thick chart? And what's the length of your Bollinger Band?
Okay, first thing first, the DC palm oil versus the FCPO. Okay, the Bollinger Band that I chose was a 3-hour period. Okay, and then I'm using a bandwidth of between 80 to 100 ticks spread points basically. Basically after I converted the FCPO into CNH, for example, I converted it into spread point, and then I designed the Bollinger bandwidth to be around 80 to 100, which I find in my experience work best for this particular spread. Sorry, did that answer your question?
All right, thank you, Mike. Let me see. Any more questions from the audience? We can take 1 or 2 more. All right. Question 4. If you trade DCE January versus FCPO January contract, does that mean you only have a few months worth of data for back testing for each pair? Can you trade DCE January against other FCPO months such as February or March?
Yes and no. Okay, first of all, why did I pick the Jan, May, and September? Okay, now uniquely for DC, for example, now the traders favor the Jan, May, and the September contract. They usually are the ones that's trading with the highest liquidity, volume, and flows. When you trade spread in this nature, you want to be able to take advantage of flows, especially when flows that actually push one of the market in an opposite way, that push it towards one of the historical extreme. That's how you set up your trade. All right. The more of this type of flow, the more of this type of liquidity, the more trading opportunity you will get. You can obviously trade different expiration. Like for example, if current spot month is February in the FCPO, for example, right? You can trade it against the May. You can trade against the February Dalian palm oil as well. The trouble is you probably not be seeing, or you not be doing yourself any justice, because it is tradable, but it's not going to be the one with the most opportunity, is what I'm saying. Okay, and then given that consideration of liquidity, right? We want to trade. You understand when we talk about, or when we propose mean reversion, we are talking about movement that actually cause the spread to move to historical extreme on either side of the Bollinger Band, for example. For that to happen, right, one of the contract or both of the contracts will be moving in opposite ways for whatever reason that's causing them to move. And the more we see these type of opportunities, the more you'll be able to put up trades in those situations. All right, so you actually need to consider what are the most active contract, and which is why I show you when I'll be trading the Jan, May, and the September, during which period the consideration was big when the contract takes over the leading month row. When I say leading month row, I meant it to mean where it's actually receiving the most attention in terms of flows and orders, and that's where I want to be, and that's how I match it.
All right, on to our next question. For spread trading, is it just purely analysis using the charts, or can we incorporate fundamental analysis also? How do you incorporate fundamental analysis into spread trading?
Okay. Like I mentioned earlier, right? So you can actually study historical price relationship on the chart. You draw up from past data and everything. That is the price information, which actually I subscribe to the fact, to the theory that the price data will probably have discounted every information there is to been discounted. Now, that is not to say that you should not bother with fundamentals at all. Like I said earlier, for example, if you were trading a seasonal trend, for example, I would actually trade more confidently and more comfortably if I know what is causing this seasonal pattern to occur. And then at least I know when I'm seeing it whether it's repeatable and it's something I can do and I can set up and do it. For example, if you talk about palm oil versus FCPO spread, okay, what's moving one, what's moving the other, for example. Now, demand and supply dynamics, obviously, right? Inventory numbers, they all subscribe to different sets and behave, or rather be affected by local news more so than international news in a way. So you need to know what is moving a particular market. Say, for example, if one day you woke up and then Dalian palm oil started moving way high, while FCPO has not started moving yet. Okay, then you'll be looking for what's the reason behind the move. Now, if it's purely a flow-driven kind of thing, that's your opportunity to enter a short spread trade in a sense. But if there was a reason for this move, for example, let's say if they were restricting foreign access or whatnot, for example, then you will have issue trading this particular spread. And that's not a good example, but we talked about the seasonality earlier. It basically means that even though you can see this relationship, you probably want to know what's moving it, what's keeping it that manner to be able to trade it comfortably and consistently and comfortably. Okay.
All right, thank you so much, Mike. Let me just see if there's any more.
Sure.
All right, the last one for the day is, does the new night trading session affect the volatility of FCPO? I believe this falls under the remit of Mr. Ryan. Do you have comments on that question? Did you get the question, Ryan? I can repeat it once more. Yeah, so the question is, does the new night trading session affect the volatility of the FCPO? Oh, right. Okay, just one second. I believe, let me unmute you. Okay, try again, Roy.
Right. Okay, it's good now. So in fact, the reason for launching T+1 trading session is to reduce sudden volatility, in fact, right? Because if there's a lot of action or news coming in during the US hour, at least when the contract is trading, people are able to actually do something about the position, right? If they want to go, they want to enter a new position, or they want to exit an existing position, they are able to do so. This is actually to prevent a huge gap that could happen the next day if T+1 session is not available. Yeah. So my short answer is it is actually to reduce sudden or what do you call this uncontrolled volatility.
All right, thank you so much, Ryan and Michael and Ken. And thank you for being a wonderful audience with all the really, really thoughtful questions related to what we covered today. If you have more questions, it doesn't have to end here, all right? There's a feedback form right at the end of the webinar, and you can type in your questions at the end. If you have any other queries, you can let us know via the feedback form as well. And thank you for being a wonderful audience once again. Thank you, Michael, Ken, and Ryan.
Thank you, guys.
Right. Thanks all.
Thank you.
All right,
Have a
that's
good
all the
evening.
time we have for today. Till our next webinar. See you then.
Okay,
Good
bye-bye.
night.
Bye bye.
Right.